So the Magnificent Seven stocks dominated returns out of the October 2023 low. But here in 2024, we're starting to see some differentiation, or what we call dispersion, between the returns of these leading mega cap growth names. Tesla, one of the first to really look different than the rest of the pack, and Apple following soon after. This week, Apple got hit with antitrust legislation, but I would argue the chart's been telling you it's more of a risk-off play here well before this week. Today, we're going to break down the chart of Apple and see what they can tell us about the long-term, medium-term, and short-term prospects for this key growth name. I'm Dave Keller with Market Misbehavior. Before we get to the charts, here's one more thing I want to tell you about. I'm a technical analyst, which means I spend hours every day looking at hundreds, if not thousands, of charts. But in my own decision-making process, it's not purely technical. I actually spend a decent amount of time looking at fundamental factors that are actually driving companies and empowering them to grow for multiple years going forward. I look at macroeconomic data like the Fed and inflation and interest rates to think about how all those factors might impact those stocks and ETFs that I'm looking at. And I also have learned from spending years working with institutional investors that having a good quantitative model is super important. What a quantitative model does is basically look at the characteristics of successful stocks, looks at all the factors, technical, fundamental, everything, and wraps it into one rating, and then allows you to focus on the best opportunities within a particular set of stocks or ETFs. The good news is, as an individual investor in 2024, you have access to a pretty decent quantitative model through Seeking Alpha. If you go to marketmisbehavior.com/seekingalpha, you'll be able to take advantage of their quantitative rating. They actually have a pretty sophisticated quant model that is driving their quant rating. You can then cross-reference what we're talking about on this video, is looking at the charts of leading stocks, looking for big base breakouts and good technical opportunities, but also look to see if the quantitative model from Seeking Alpha supports the upside potential of those names. So go to marketmisbehavior.com/seekingalpha to find more information. Usually get a better deal for you. It's an affiliate link, which means it helps me make Market Misbehavior awesome, and we're all happy. So check it out, and let's get back to the charts here. So I was taught that whenever you're trying to make sense of a name that's in a bit of a transition period, you want to take a step back from the daily chart to the weekly chart. Or what they say, when in doubt, zoom out. So we're looking first at the weekly chart of Apple, and we're going back for the last 7 years. So each bar represents 1 week of trading. We have the 40-week moving average in red, the 150-week moving average in purple. Why do we use the 40-week? Well, if you think about it, 40 weeks is about the same as 200 days. And the 200-day moving average, probably the most widely followed of them all. So having that represented on our weekly chart makes good sense. So we have the 40-week moving average in red, the 150-week moving average. I've often found when you're looking at a longer term time frame, it's a great way to just get a sense of the longer term trajectory. And two things to keep in mind. Number one is the 150-week moving average trending upwards. And as you can see, over the last 6.5 years, that's certainly the case. And you will often find when a stock is in a pullback phase within a longer term uptrend, you will find it often finds support at the 150-week moving average. That's why I've learned to use that. Below that, we have the weekly RSI. At the bottom, we have the weekly MACD, or in this case, PPO. Very similar indicators, trend following indicators, looking at the overall trends sloping upwards or downwards. 3 takeaways from the weekly chart of Apple before we get to the daily and what's happened here in the short term. Number one, just the fact that Apple, of course, has been in a long-term, what we call a primary uptrend, right? That overall trend over the last 7 years has been positive. Now, we've had a bit of a consolidation here recently where highs and lows have been fairly even, but if you look at the long-term story of Apple, of course, it's been quite strong, right? At the end of 2018, Apple's trading below $40 a share, and in the last year, we've been threatening $200 a share. So about a 5-time gain, 500% gain there, which is pretty meaningful. Below that, the second takeaway I would say would be the fact that we've started to see some decline in these key indicators, right? So if you look at the RSI, it's been trending downwards over the last 6 to 8 months. You can see that the PPO indicator actually gave a sell signal here in July of last year. And the PPO indicator, basically a buy signal, is when the PPO line or the MACD line in black crosses up through the red signal line. Here we have a sell signal where it crosses down through the red signal line. That happened pretty soon after the July 2023 high. So the fact that we've seen RSI become overbought, the PPO indicator get to a pretty elevated level, and then both of those sort of rotate lower, sort of suggested that July 2023 high was a pretty meaningful one. The third takeaway I would say is just overall the fact that the RSI is right down to that level where it starts to look a little more bearish on the long-term time frame, right? When an RSI is above 40, especially on pullbacks, tends to be a little more constructive. When the RSI is down in this sort of 40 to 50 range for too long, it usually tells you we're in more of a sort of a primary downtrend. And you see that sort of the range that we've been in here for the last 6 to 8 weeks. So the RSI hovering between 40 and 60, certainly not in a position of strength, not completely beaten down, but more sideways than anything. So the weekly chart, sort of a good place to start because it gives us this sense of the long-term uptrend, shows us how the moving averages really show this overall primary positive move. But in the short term here in the last year, you see how things have started to change a little bit. Now, another thing we can do is do a more systematic analysis of price trends. I have a model called my market trend model. I actually run this on the S&P 500 every week, every Friday at the close. I look at this chart with the S&P 500, and for the record, as of Friday, March 22nd, bullish on all time frames. Long-term, medium-term, short-term, all bullish. Now, my market trend model is based on weekly price data. So this is a weekly chart of Apple going back for the last 5 years. Then you have this spaghetti-looking set of moving averages. And these are the 5, 13, 21, and 34 moving averages. Years ago, I tried to come up with a systematic way to use exponential moving averages to quantify the trend on 3 time frames that were of interest to me. The short-term time frame, a couple days to a couple weeks. The medium-term time frame, a couple months. The long-term time frame, over a year. And by using this combination of exponential moving averages, and I put a link below for a video on my channel where I describe in a little more detail how this market trend model was created and how you can use these different time frames. But for the record, if each one of these is above the 0 line, it's bullish on that time frame. If it's below the 0 line, it's bearish on that time frame. So the long-term trend, by my reading, has been bullish since March of 2023. And again, you can see it takes a little while after the bottom and at the end of 2022 for the stock to recover. It took a couple months, about 10, 11 weeks in that new year before the long-term model turned from bearish to bullish. The medium-term model is here in the middle in green. You can see it actually turned bearish at the beginning of February. So sort of recognizing this medium-term trend, again, about a couple months or so, is in a primary downtrend. Then we have the short-term model, which simply looks at where we're at relative to the 5-week exponential moving average. You can see that actually turned negative really at the end of January. It turned slightly positive there at the end of January, but for the most part, most of 2024, this has been below the 0 line, telling me that the short-term trend overall has been pretty negative. So at this moment in time, after we locked in Friday's close, the long-term trend is still positive, but very close to turning bearish. And the last time it turned bearish was back here in September of 22, which ended up being another 3 months of price deterioration before the eventual low. Keep that in mind. The medium-term model is already bearish. It actually turned bearish in early February. The short-term model also is bearish. It also turned bearish in early February. So my systematic market trend model is basically telling me it's risk off on the short-term and medium-term timeframes. The long-term timeframe is still bullish, but very, very close to turning negative. Now, with that as the backdrop, now that we've sort of had this understanding of the long-term uptrend on the weekly chart, how that lines up with our long-term market trend model, the medium-term and short-term, which have already turned bearish, let's look at the daily chart of Apple and see how the last couple months, last year or so have played out on the chart here. Here we're looking at the 2023 low, and really we bottomed out at the end of 22, beginning of 23. Look at this V-shaped bottom and the nice rally. And we're going to start here with the low in January of 2023 and the high in July of 2023. And the reason why we're doing that is we're using what's called a Fibonacci analysis. What this does is basically say if that is the initial move, if we pull back within this range, what levels might we expect some key support? And look how beautifully Apple has played with these Fibonacci levels almost perfectly. The 38.2% retracement, which is that main first level to watch, is just above $169 a share. You can see that's basically where the September 23 low ended up. In October, we undercut it by about a couple days before bouncing higher, and earlier in March, we hit that same level again. In fact, we've actually bounced off of 170 here a couple times, and this week, the low for the week, was just above that Fibonacci low. So I would argue more and more we're confirming this as an important level of support to pay attention to, which means the more it's tested, the more it's validated, and also means if and when we finally break through that level, that's a pretty significant sell signal to watch for. Now, also glance down a little bit to the price momentum, and you can see that the RSI, which is a measure of momentum that I like to use the most, look in November and December, higher highs in price, lower peaks in momentum. This is a classic pattern called a bearish momentum divergence. And one of the first things I look for at the end of a bull market phase and as a sign of potential trend exhaustion is to look for a bearish momentum divergence. That's where the market still goes up on whatever chart you're looking at, but the momentum is starting to slope downwards. That's exactly what we saw in December of last year, which suggested to us we were probably heading lower before we would make a much more meaningful upside. Now, that bearish divergence, very importantly, happened at a key resistance level. So that signal occurred in December, which is at the same price point where we topped out in July. So it really showed me a high probability that we would have sort of a double top pattern. The weekly chart, that double top pattern really jumped off the page at you. Look at how that January high was then essentially a retest of that previous peak around $197 to $198 a share, and from then we've rotated lower. Finally, we can now look at levels of support. Look at the 200-day moving average, which served as support in October, served as support in January and early February, and then we finally broke that about a month ago in mid to late February. Look at the fact that when the market is going higher, we have higher highs and higher lows, but if you look at the last 8 months, it's basically been fairly steady, right? On the medium-term time frame, we have a clear resistance level and a clear support level. So the stock has really been range-bound between around 168 to 170 and 198 to 200. So at some point, we break out of that range, either to the upside or the downside. I'm wary. I would say I'm more expecting that this probably breaks down. I think a chart like this is more guilty until proven innocent, especially given the fact that we have all of these signals that I've mentioned up until now, the divergences, the rotations, the sideways movement, and so forth. You also have to note on a tactical time frame, what's great about technical analysis, what I'm really illustrating here using the weekly and the daily charts, is what we call the fractal nature of technical analysis. That's when patterns and movements and signals tend to be relevant on longer term and shorter term time frames. You often find some similarities between multiple time frames as well. Just look from the December peak to the first low there in early January. We retested the high, we retested the low, we finally broke it, right? And that's that red horizontal line right around 180. Once we broke below that level and found support at this Fibonacci level, we then bounced higher. And look how we stalled out in the last week right around 180. So this level 180 is what we'd call a pivot point. This is a level of support, which has now become a level of resistance. So overall, I would say the fact that Apple is no longer going up as defined by my market trend model and those different time frames, as defined by just this clear sideways pattern, what we'd call a basing pattern on the chart. So it's definitely not going up, but it's not necessarily breaking down just yet. Now, in the short term, on that tactical time frame, it is breaking down because we've broken below the 200-day moving average, we've broken below support levels and pivot points, and have continued to now make lower highs and lower lows. The last thing to look for, I would argue, is to break through this final level of support. And I would say if Apple gets below 168, that would take us below this Fibonacci level. That would clear the way at least to the next Fibonacci levels, if not further, maybe 150, which would be a 61.8% level retracement of that rally. It could be the eventual low. Hard to tell, but I think the most important thing about technical analysis, it gives you a practical set of tools to follow these charts on the way down. Now, the final point I will make about Apple is, regardless of everything we just talked about, the fact that the relative performance is so weak is probably one of the most important reasons why Apple has not been a particularly strong stock. It's not that the price has lost much on an absolute basis, but it's on a relative basis. If you look from the end of November around Thanksgiving to where we're at now in late March, the relative strength line here at the bottom has gone down, and that means Apple has consistently underperformed the S&P 500. I was taught if you want to outperform the S&P, you need to own things that are outperforming the S&P. For now, Apple is not one of those stocks. What do you think about Apple? Look at these multiple time frames from the weekly to the daily, using some of these techniques that we talked about. You're bullish or bearish on Apple, and why? Don't forget to drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Have a good one. We'll talk to you again soon.